Welcome to Turning Point's Clearway Capital Solutions podcast series, where we talk to leading investment managers and general partners in their respective asset classes about the evolution of their markets and how they're responding to these changes. Established in 2008, Clearway Capital Solutions is an independent and privately owned company providing business development and capital advisory services to investment managers in alternative and traditional asset classes who are seeking to engage with Australian and New Zealand investors and their consultants. The Turning Points podcast series provides listeners with direct access to the insights of our investment partners.
Today we're joined by Justin Slatky, Chief Investment Officer from Shenkman Capital Management. Shenkman is an independently owned corporation with a 35-plus year history of adhering to proprietary bottom-up fundamental credit research, process-driven rules-based decisions, and the avoidance of defaults across their portfolios. Shenkman Capital offers leveraged loans, senior secured loans, high-yield bonds, short-duration high-yield bonds, multi-strategy credit, structured credit, stress credit approaches to investors. Shenkman Capital has a substantial client base in Australia. Hi Justin, thank you for joining us today on the Turning Points podcast. Could you provide some historical background on Shenkman Capital Management?
Thanks for having me, Dennis. Shenkman Capital is a traditional and alternative asset manager solely focused on the below investment grade credit markets for the last 39 years. We are privately owned by the team members that manage our clients' money every day. And we currently manage over $32 billion in assets, US dollar, where we are focused mainly on the institutional market. We're happy to say we've been managing money for the Australian market for over 14 years. And we are fundamentally driven with over 50 investors focused on the research, portfolio management, and trading part of our business.
Please tell us briefly about yourself and your role at Shenkman.
Sure. I'm the CIO of Shenkman Capital. I've been at the firm for over 13 years. I focus on the macro overlay of our products, as well as a focus on the opportunistic part of our business. Prior to joining Shenkman Capital, I came over from Goldman Sachs, where I was for over 10 years. I ran the high yield distress business for Goldman on the broker-dealer side in New York, London, and Latin America. I was on that desk through the 2002 and 2008 crises, so great times to learn how to invest in more challenging credit markets. Prior to that, I was in high-yield research covering telecom companies in the late 90s and early 2000s. I did that at Goldman and at Credit Suisse, and came out of Wharton Business School prior to that. So approximately 25 years of experience, all in below investment grade credit.
To kick things off, in your opinion, what are the fundamental dynamics that shape sub-investment grade markets today?
So the dynamics of the below investment grade market have actually changed quite a bit. When we think about the last 10 years or so, it has really been a beta-oriented market, driven by government influence and government capital put into the financial system and the control of interest rates. Now we have moved into an environment where we are at a higher rate for longer environment. As that happens, what you will begin to see is more idiosyncratic risk begin to play out as there's a hurdle rate for companies, the risk-free rate, which is much higher than it's been. And during that period of time, you are likely to see winners and losers play out. And so you'll see dispersion of return. We think that's much different environment than what we've been in the past. It will also mean different things for different markets. So if you look at the bank loan market has increased in credit risk over the last 5 to 7 years as private equity has really leaned into using that market. And that is often where many Australian investors have their credit risk. The other market, the unsecured bond market, really has duration risk, but has much less credit risk. And so as this dynamic plays out of idiosyncratic risk, we expect both markets to provide different types of opportunities.
This year, rate volatility is likely to be significant. What do you think is next for the US Federal Reserve and credit markets?
Yeah, so betting on interest rates is always challenging and quite treacherous. Really coming into this year, most of the world was really waiting for the Fed to cut rates. We have a belief that the Fed is likely to keep rates higher for longer, which is where we've been. And most of the market has really started to adjust to that fact. And we've seen that kind of across the rate curve. As we sit today, we think the Fed is really where they want to be, where they have plenty of room to cut if they see things weaken or they see inflation really come down, but they don't have to act as the economy continues to do well. We are in the US getting much closer to the election cycle. And the closer we get to that, the less likely it is that the Fed will do something right in front of the election. Now, post-election, there is still a November and December meeting, so they have two more opportunities to cut post-election. We would anticipate they would wait until that time before really doing anything, unless you see a very material change in the economic environment, which means for corporate credit, it should be a strong coupon clipping environment.
Justin, how would you define opportunistic style credit investing?
Opportunistic investing means many different things to many people. For us in the below investment grade credit world, it really means taking advantage of volatility in the credit markets, which are caused by idiosyncratic events. So events happen in individual names and the ability to take advantage of them quickly. Now, we do that through several ways: stressed credit, catalyst-driven investing, long-short, cap-arb, distressed, and market transition are some of the themes that we focus on, where as events play out, we have a speed to market advantage, as many of our analysts already cover companies before something goes wrong. And we can take advantage of market overreactions to those situations with an attempt to achieve double-digit returns.
Currently, what are the prospects for opportunistic style of credit investing, and or what are the scenarios you are positioning for?
So the opportunities in the credit market change quickly depending on the environment that we're in. We happen to be in a unique period of time that's providing a very specific type of opportunity in below investment grade credit. And that is that private equity sponsors in general have not been able to monetize their investments. That's because equity prices have been lower and rates have been higher. As a result of them holding on to their companies, many private equity sponsors are coming close to the maturity of bank facilities. Those bank facilities trade below par. Now, private equity does not want to give these companies up in a normal bankruptcy situation because these companies are performing fine. They're just not at the EV that makes it profitable for them to monetize. So they have to push out maturities. There is a real opportunity to buy short maturity bank debt at a discount and then work with private equity to extend maturities and get paid for that extension, either through higher coupons, better covenants, or better call protection. We think this is a unique, very good upside downside investment opportunity that rarely exists in our market, buying good companies with weaker balance sheets.
Have the type of catalysts that you historically invested in changed over the last 12 months?
I think from a catalyst perspective, 12 months ago, we were just at the beginning of private equity realizing that they couldn't monetize investments. So I think that catalyst has really played out throughout the year, and we think will play out for the next 12 months. Now, the way it's played out has changed dramatically. I mentioned that initially the opportunity was really to negotiate with private equity and extend maturities. As the 12 months have gone by, what we've seen is private debt has stepped in to refinance many of these capital structures and therefore taken out public credit at par. And then as the markets have even strengthened more as we moved into this year, public markets have been willing to refinance many companies that they were unwilling to 12 months ago. The other major catalyst that's occurring in the market is a pickup in M&A. We have M&A up about 20% year over year, and that really helps the below investment grade credit market because many of our securities are trading below par. And when M&A happens, there is usually a takeout provision where we can get taken out at par or better.
Justin, if I can get 5% in a term deposit, am I getting paid to take the incremental risk?
The overall high yield market trades at approximately a yield to worst of 8%, and bank loans are yielding north of 9%. In addition, the average dollar price of the high yield market is around 96 cents on the dollar. So you're kind of in the mid 90s with high yields across the marketplace. When you combine that with the fact that defaults are really low, and as we look at the overall economy, are likely to stay depressed relative to historical numbers, it seems like a great environment to get involved in corporate credit. We believe this environment reminds us of the early 2000s, where there were lots of winners, but there were some default rates and defaults that occurred in the market. But it was a great time to have interest income generate and compound upon itself, in addition to capital appreciation opportunities. And that's the type of market that we believe we're in.
What do you think about the relative value between public and private credit markets?
Over the last 2 years, private credit has grown dramatically in the amount of assets that it has accumulated across the U.S. in different asset managers. The way we think about public and private is it's the same type of risk. It's just a matter of which market the company wants to finance itself in. Certain periods of time, private credit will be cheaper. Certain periods of time, public credit will be cheaper. And you will see companies shift between those two markets. Now, as we sit today, as I mentioned, Dennis, earlier, public credit is trading at a discount to par, at a relatively material discount, which provides investors the opportunity to have capital appreciation in a relatively low duration asset. We think that provides really significant opportunity in public versus private as we sit today. In addition, as we think about the election cycle coming up, the ability to change your mind as an investor will be very important, because what happens in the US and who gets elected could dramatically change what policies are put in place. And so when you have that kind of unknown coming up, we believe being in public securities where you can change your mind and you can reallocate your portfolio based upon what is likely to be very significant news is really important. And so in today's market, given where we are in the US in the election cycle, we think leaning towards public credit with its discount to par and ability to change your mind is really important, and we lean a bit more towards public credit today.
Speaking to your analysts, what are the company's views about the current operating environment?
I think one of the most surprising parts of this year has been coming into 2024. There was an expectation that the economy would weaken up, that the U.S. consumer would be very weak, and we would start to see more challenging results. And that is not what we've seen. We've just completed the first quarter. And within the first quarter, the majority of companies beat expectations in the high yield market. And in fact, only around 10% of companies lowered their expectations for the rest of 24. So that's a very low percentage. So what it's telling you is that most companies feel pretty good about what they're seeing in the current operating environment, and that the consumer continues to hold up, which we see through a number of different statistics that we look at. Now, that being said, there are some cracks that are in very specific industries. Cable and telecom in particular are challenged given the technological changes that are going on in those industries. And we're likely to continue to see more challenges in those spaces as we look forward.
Defaults are not up over long-term averages. What are your expectations going forward?
As we think about defaults in the current environment, I would break apart the bond market from the bank loan market. As I mentioned earlier, the bank loan market has a bit more credit risk than the bond market. So when we do get to a default cycle, we would anticipate bank loans likely having a higher default rate than the unsecured bond market. Now, that being said, in the short term, we believe that default rates are likely to stay relatively low. As we spoke about, the economy is doing well, companies are generally doing well, and there's a big change in the market in creditor and creditor violence, or said another way, pushing off any default risk. And so what's happening is as companies start to struggle, instead of putting creditors together and organizing prepackaged bankruptcies where you get equity, you go into bankruptcy, and you come out, what's happening is companies are going to select bondholders to create new entities, moving their assets from one box to another, and then trying to extend maturities to try to live for another day in the future. Now, the downside of that is that bondholders and bank debt holders lose assets as they move from one end to the other. The benefit is that defaults are pushed off. And so it actually keeps default rates lower than you would have historically seen. And so what's important as we look at the US is to look at really the default rate as we would normally look at it and defaults plus exchanges. And what you will see is that second data point has started to grow, as we've moved into this year, as more and more exchanges are getting done between companies and debt holders.
What would you say to investors who feel spreads are tight, Justin?
So spreads as we sit as of last night are a little over 300 off, and that is historically tight by really any historical standard. Now, what we have told our investors is they should anticipate spreads staying tighter than expectations for an extended period of time. One is the default risk, which we talked about, and it's much lower than it has historically as the companies are stronger. Two, there is a demand-supply imbalance within the high-yield market. If you think about the last 7 or 8 years, rates have been very low on high yield, and so it has not attracted a lot of new investors. Over the last 12 months, as rates have gone higher and yields are higher, we've started to see many more investors start to think about and look at fixed income, inclusive of leveraged finance. And so the demand side has started to increase. I wouldn't call it actually a full allocation cycle yet, because I think a lot of investors have been holding off because of spread, but we have had some new investors come to the asset class. And more importantly, we've had some old investors increase their allocations. As that happens, demand goes up. The supply has not increased. LBO activity is low. M&A has been investment grade, taking over high yield companies. And so we have not seen really significant growth on the supply side. So as we look forward, we think we're going to be a higher rate environment for a while. That demand and supply is likely to stay imbalanced for an extended period of time. And that is likely to keep spreads at a tighter level than what an investor might normally anticipate. That being said, the all-in yield is really quite attractive in our markets. And it's a great place to play to get interest income and allow that to compound while there are these uncertainties, political and global, that are in the marketplace.
How does a credit strategy adhering to an opportunistic style offer a different return stream versus traditional high yield, Justin?
Sure. Dennis, I would say in a couple of ways. From an opportunistic standpoint, we're generally trying to take advantage of mispricings in the marketplace. So there's an event that happens, there's volatility that picks up, and in opportunistic, we're trying to take advantage of that through our credit skills to buy in when the market is concerned about certain situations or has put too much concern in a situation that we think is going to turn around. In addition, on the opportunistic side, when spreads are very tight, we're really looking for alpha opportunities to short the market. And so we can really play on the long and short of the market from an opportunistic standpoint. In our traditional high yield business, we're really trying to clip interest income. And we're trying to let that interest income compound upon itself. make as few mistakes as possible, avoid the challenging credits, and let the majority of the portfolio work for you while you sleep at night. And those are going to create different return streams and different opportunity sets between them.
Is opportunistic style credit strategy tied to a particular part of the cycle?
Opportunistic investing, as we were talking about earlier, can mean a lot of things to people. So if you raise a drawdown distressed fund, it's going to be tied specifically to the cycle. It's going to put money to work when you see defaults pick up, and it's going to try to buy discounted securities. We are not really in favor of that strategy today, mainly because of what we mentioned earlier with all of these distressed exchanges going on. It's increased the variability of outcomes for the distressed market and made distressed very challenging to invest in. Now, as we think about opportunistic, we like to think of it more in an all-weather way, which is when there is a lot of volatility, you can buy stressed high yield, meaning names are down, but you don't think they're going to go bankrupt. You think they can recover. When names are tighter, you can do cap arb, long short credit, and invest in an environment where you protect on the downside while really trying to play for spread widening. And so we think that opportunistic is really an all-weather strategy when it's executed most effectively.
Justin, thank you for joining. Do you have any final thoughts or themes you want to leave listeners with?
I really appreciate the time, Dennis. I think that when we look at our business, which has investors all over the globe, many investors in below investment grade credit are very focused on spread and the tightening of spread. And we think they are missing the idea that many of these securities are trading at a discount. So as we sit today, you have a long opportunity from the discount in the market and the overall high yields, but the low spread environment provides an excellent opportunity to find alpha-oriented shorts. And so if you could find funds that can take advantage of the high yields, but also defend using alpha opportunity shorts, we think that's a really unique place to play today. And we're very excited about the opportunity set that we see.